Assalamualaikum warahmatullahi wabarakatuh. So today we already come to the final topic for the semester, which is with regard to the capital allowance on plant and machinery. Okay, under this topic, what you're going to learn is that on the first slide, I will show to you the format of computation of CA in Pangkasan, okay, which already been covered in the previous slides actually when we do business income. And then we are going also to look at what is the format of computation for current year capital allowance, and we will look at the terms, okay, definition of terms in capital allowance, how does it relate to what you have learned in accounting, and also in order to claim capital allowance, what are the qualifying criteria and what are the eligibility of the capital allowance. And after that, we will look at the special occasion or special treatments of the capital allowance when we have hire purchase, when we have disposal, and when we have assets bought and disposed within 2 years. And finally, if you have any unutilized current year capital allowance or any capital allowance which is not being utilized in the current year of assessment, what do we do? Okay. Let's proceed to the format of computation. This one we have covered earlier, where capital allowance will be appeared after adjusted business income in order to derive to statutory business income. Okay, as already been discussed, has already been explained, adjusted business income will be at your balancing charge, and then minus capital allowance, which would consist of capital allowance brought forward, capital allowance for current year, and also balancing allowance. So balancing allowance and balancing charge normally derive if you have any disposal. So later we will look at how to compute balancing charge and balancing allowance. Capital allowance brought forward is actually unutilized portion which carried forward from previous years. Alright? And then current year is the one that we calculate based on the qualifying expenditure that we have during the basis period for that year of assessment. Okay, this is the format actually we should follow. Okay, you should follow in order to show the computation of capital allowance. Okay, on your left hand side, you would have different types of plant and machinery. Okay, you can have office equipment here, purchase furniture and fittings here, okay, machinery here, or different types of plant and machinery. Okay, and then here you would have qualifying plant expenditure instead of cost, because whatever cost that incurred during that basis period, we have to identify whether that cost is actually qualified or not to be for you to claim capital allowance. So we call it qualifying plant expenditure. And then this is the initial allowance and annual allowance, and this is the rate. Okay, this is the rate, right? And so based on the qualifying expenditure and based on the rate, therefore we multiply, then we get the amount for the respective year of assessment. Okay, you see, for the respective year of assessment. So it depends on when actually you incur the qualifying expenditure, therefore you match to the respective year of assessment. Okay, the final one here you can see, okay, there is a disposal, right? There is a disposal. So you have here is residual expenditure, disposal value, and balancing allowance, right? So this is how it would appear in the format of this table. And the final bottom part is actually the total capital allowance for the respective year of assessment. So if you're talking about current year capital allowance for YA 2014, so this is the amount. If you're talking about current year capital allowance for YA 2015, this is the amount, right? So this is for the respective year of assessment. Okay, moving on, now we look at the definition of terms that we are going to use in order to compute capital allowance. Okay, the first one, it is plant and machinery. Okay, for the tax purpose, they will combine all types of PPE under plant and machinery category. Okay, because the other types of capital allowance, we will call it industrial building, which is normally related to the plant, the big plant or the building of the, for instance, like factory and so on. So for tax one, we only cover plant and machinery. Okay, qualifying expenditure is actually similar to what you learn in accounting, which is cost. Right. However, for the tax purpose, we have to identify whether whatever cost incurred, okay, whatever cost incurred during that basis period is actually qualified or not. Okay, so we have to identify. That's why it is called qualifying plant expenditure. That means it fulfills the criteria to be qualified. Okay, initial allowance is actually similar to the concept what you learn in accounting, depreciation. So you have initial allowance, you have annual allowance. Initial allowance only given in the first year of purchase. Okay, initial as the word first is only given in the first year of purchase. However, annual allowance is actually given every year. Okay, annual allowance is actually given every year. Okay, residual value or tax written down value is actually similar to your net book value. So you have your cost, you minus your accumulated depreciation. So you minus your depreciation, therefore you have net book value, right? So here they call it residual value or tax written down value. Okay, then in the occasion where you have disposal, normally in accounting you compute gain or loss on disposal. However, in the tax occasion, we did not call it that. We call it balancing charge and balancing allowance. That's why when we compute, okay, our when we do our tax adjustment, if you recall, whatever gain or loss on disposal will be adjusted. Okay, will be adjusted or will be added back. Okay, then they would have their own balancing charge and balancing allowance in the context of capital allowance. Okay, qualifying aspect. When can you start claiming? Okay, when can you start claiming your what is this? Capital allowance. Okay, in order to claim capital allowance, okay, first thing you must be a person who is actually carrying on a business. That means you must have a business. Alright, only for those who have business income can claim capital allowance. And secondly, you must have incurred the qualifying plant expenditure. So you must have incurred that by you, not by other person or not by other business. Okay, because here you must have whatever capital allowance that you claim for that business, the assets must be used in that business. Okay, it cannot be used for other business, then you claim for the other business. And then that is explain the third condition where it must be used, the assets must be used in the business. So you must fulfill this criteria, then only you can claim your capital allowance. Okay, next one is how to identify your qualifying expenditure. Of course, you must incur that qualifying expenditure in order to purchase the plant and machinery, and that plant and machinery is actually being used for business. Okay, the next one is alteration of an existing building for installation of plant and machinery. Okay, for instance, you buy a server. Server is actually quite big. Okay, therefore you need to do some modification to the existing. Okay, let's say you want to put that server in a room. So, in order to put that server in a room, you have to modify that server. You have to modify that room. Okay, whereby you have to make sure that it is locked. Okay, it is proper, because when you want to put a server, it must be locked, it must be difficult to access, and it must be air conditioned and so on. So you have to modify that room. Okay, let's say before this the space there is no proper wall, no proper door and so on. So you do that alteration. So whatever alteration cost that incurred in order to install that plant or machinery, for instance server, therefore that alteration cost can be capitalized. So when you capitalize, therefore that cost will be considered, is it qualified for you to claim capital allowance or not. Okay, so that's why, as I mentioned, qualifying expenditure is not only purely for the cost of the machine, but also the cost that incurred in due to install that particular plant and machinery. Okay, the next one is the cost that you incurred for preparing, cutting, tunneling, or leveling the land for installation of plant and machinery. Okay, for instance, you want to install crane. Okay, let's say for the port business. Okay, at the port for the ship. Okay, where you want to do import, export, all those things. So you want to install crane. Okay, at the side of the beach. Okay, for the purpose of you to build up the port. Okay, so initially before you install the crane, what do you have there is actually land. Okay, therefore, in order to install that crane, you have to modify, you have to prepare the land, okay, for it to be ready that you can install your particular crane itself, right? Therefore, you have to cut, you have to tunnel, or you have to level the land. So you do incur certain costs in order to modify the situation of the land in order to install the crane. Okay, so here there is a condition that whatever cost that you incurred to modify the land, it must be 10% of the total cost of your plant and cost of preparing the land just now. So for instance, the cost of the crane is 100,000, okay, and then the cost of you to cut or leveling the land is 20,000. So total cost of plant and cost to modify the land is 120,000. So if you take 120,000, 10% from that is actually 12,000. So if you compare the cost of the L, okay, the cost of cutting or leveling the land is actually 20,000, right? So 10% is 12,000. So 20,000 is greater than 12,000. Therefore, in this situation, that 20,000 will be non-qualifying expenditure. However, it will be non-qualifying. So what will be the qualifying expenditure? Therefore, it only will be 100,000, which is the cost of the crane just now. Alright, so it must be less than 10% of the total cost. Okay, you can also see example in your textbook, example 18.2, page 292. Okay, and then what other qualifying expenditure also can be included? Okay, this one specific for agriculture industry where you have fish pond, animal pens, chicken houses, cages, and so on. So whatever the cost that you incur to build all this also can be considered for qualifying expenditure.